Many people say, Mr. Yap, you're not the first one to say that I should be careful with my money, I should invest in safe investment. Newspaper, minister, member of parliament all say that. Okay? But then, what do you mean by safe? No? What do you mean regulated and safe investment? So that's why today I decided to introduce a investing rules that I have established for my firms, for the clients of our firm for many years to serve as their reference when they invest serious money like retirement asset. And we call that SRB standard for retirement asset investing. Okay. So over 20 years, we have done many financial plans for our client, and we have helped them to invest their investment according to a standard that we call SRB standard. Okay, by adhering to SRB standard, you will be able, or our client will be able to confidently beat inflation, no problem at all, and compound their money to achieve financial freedom without taking unnecessary risk. Unnecessary risk, and enjoy the peace of mind. Like most of my clients, I don't know what, playing golf, swimming, going holiday. But they just don't bother about investment because to them, they just want that investment to work for them. By not taking too much risk, let them have a peace of mind so that they can pursue their interest and fun in during the retirement. So today I'm going to share with you what is this SRB. The first S of SRB standard stands for safe. Okay, so this is whereby we want to make sure it is safe. Okay, when we invest or when we put our money in FD, we feel very safe. Okay, but when we try to invest to beat inflation and gain compound return, then it is acceptable that the money may go up and down, maybe up 20%, down 20, 30%, and things like that, especially when we are in a very volatile market. However, we must not invest those investments that is so risky that may even deplete our capital 100%. This is different, because this kind of investment will be very damaging to our effort to accumulate our hard-earned wealth for retirement. Okay, so I want to define further what do I mean by safe. For it to be safe, based on my experience, the product, the investment product, got to be a regulated product. Regulated investment products are investment products that are authorized and recognized by relevant authority. And in Malaysia, the responsibility mainly fall under Security Commission and Bank Negara. So what this means that this investment product has been checked, perused by the relevant regulators, and continue to be managed and monitored according to a strict requirement imposed by the regulators. Therefore, regulated investments are generally safer from those investments that is not regulated. And one more point, locally regulated investment products generally are safer compared to those products regulated by foreign regulators. Even if we say like US, UK, Europe, or which island, what island, those are generally more risky compared to local regulator. Because why? Because if the investment is regulated by the local regulator, and it is the duty of a local regulator to protect the interest of the local investor, and they will do all they can to recoup the money. But if you were to invest into one island somewhere, be in the Indian Ocean, something like that, and something goes wrong, do you think the regulator of the particular island will do all their best to recoup a Malaysian investor money? Think about it. So number one, regulated product. Number two, it's very important that the particular investment has got a third-party trustee or custodian. An investment product that has got third-party trustee structure provide great security. In the case of unit trust investment, the trustee provide comprehensive trustee and custody service to the unit trust management company to protect the interest of the unit trust investor. Therefore, when you invest in a unit trust investor, the money and the investment asset in the unit trust scheme are always held by the trustee and not the fund managers. Imagine if there's no trustee in place, there is a risk that the fund managers may abuse and deplete the investor money, especially if they themselves also face financial problems and they are chased by the creditor. So without trustee arrangement, the investment product must have a third-party custodian at least to safeguard the interest of the investor. So this is also a very important criteria to make sure the product is safe. Okay. The third is that whatever they invest, we want to reduce the risk to our money. So it is important that the investment that you select, you must invest into the asset class that have solid value that got potential to grow. So the example of solid asset class is like cash, bond, shares, properties, gold, silver. There is a potential to grow. Okay, so when you invest in this investment, you are essentially the owner of this underlying asset. Okay, so it's something solid. The investment risk is much higher when a particular investment invests into derivative or invest into some kind of like non-solid asset. And in fact, I would suggest that we should always stay clear of the investment which has got unclear or doubtful underlying asset to prevent exposure to unknown risk. You have some investment provider who just tell you, I'm going to give you 10% return. You don't have to know what I invest. At the end of 2 years, I'll give you 20% return. And when you ask him, what do you invest exactly? You don't have to know. It's very difficult to explain to you. I would suggest you to be very careful and be very watchful when somebody answers you. Okay, so as you can see, I can share with you, these are the different type of investment product that invest into different asset classes. Okay, you have got cash, you have got share, you have got fixed income, properties, REITs, and also different type of commodities. Okay, so this is what I mean having solid investment asset. And when you invest in this kind of asset, you may lose 10%, you may lose 20% when market is having big volatility, but you will never lose everything because this asset has got a value itself. Okay, and next is that for the investment to be safe, you should not invest into investment that has got leverage or margin. Okay, so this kind of investment is very dangerous and must be avoided at all costs. Because when you suffer a loss 10%, okay, the loss will be multiplied to become 20% or 30%. And it's even possible for you to lose more money than you are available to invest. So that's why, even though the investment could be very solid, has got a very solid underlying asset, an investment with high leverage can suffer huge loss if the price of the investment decline or move it against you. Okay, so this kind of margin kind of investment is applied to share market especially, but you also be surprised to a certain investment like ETF. You can see here also has got ETF, even like invest into S&P 500. You have got their 1-time leverage, 2-time leverage, and 3-time leverage. So which means to say, you also got to be careful to know that ETF, even though they never mention about margin, whatever, is designed to have leverage. That's where that you can make multiple profit, but you can also make multiple time losses as well. Okay, and another important criteria that I believe that one should pursue for and look for safe investment is moderate risk and moderate return. You see, the return you get when you invest into low risk, low return investment will never beat inflation like FD. But on the contrast, if you invest into high risk, high return investment, you may risk losing a big amount of money or worse, your entire capital. You know, that is the reality. That is a fact of the high risk and high return investment. So if you are serious about growing your wealth to achieve financial freedom with high certainty, choose to invest in moderate risk and moderate return kind of investment with an annualized return range between 7 to 9%. So you'll be surprised based on our Wigman's experience of seeing thousands of financial plans that we produced before. We'll find most middle class, okay, with this 7 to 9% kind of return on their hard-earned money, they'll be able to confidently beat inflation, compound the money to achieve financial freedom and peace of mind. So basically, if you can achieve financial freedom with 7 to 9% return, why should you take any higher risk than that? And why should you aim a higher return than that and expose yourself to unnecessary risk? And that's what I mean by unnecessary risk at all. Okay, and that's not all. Okay, so that's why, as far as a risk-return trade-off is concerned, I would suggest, if you're serious about growing your retirement asset, you should go for a moderate risk and moderate return range. Okay, avoid all those investments that high risk, even though they claim high potential return. Okay, last but not least, under safe criteria is about regulated provider and regulated platform. So although you have done research on certain investment products, and those investment products are solid and regulated, but things can still go wrong if you were to buy and park those shares or ETF at the wrong provider or platform. So many investors experience a complete loss of their investment when they use unregulated online investment platform or provider. So always check whether the provider that you use to hold your investments, whether it's regulated or whether it's regulated by Malaysia authorities. Okay, so if I look at, I share with you an example here, you can see this particular platform is an offshore online platform. You can see it offers some very legitimate investment, like for example, stocks, commodities, currency. But this particular platform is on the investor alert list on Securities Commission for dealing with capital market activities without a license. So this is an example what I mean by, you could be buying regulated product like shares, like ETF, or even unit trust fund, but the provider could be unregulated, and that will give you unnecessary risk exposure. Okay, so that is about S. Okay, next we talk about R. What is R? R is the requirement that the particular investment must always rises in the long term. Okay, so some investment, they are very volatile, they go up, go down short term. But in the long term, they'll either go back to the original value or worse, they'll lose you money. Okay, this type of investment definitely is not suitable for you to accumulate wealth for long-term financial freedom, long-term retirement, because you cannot afford to have a surprise. Know that you accumulated 3 million, suddenly you got 1 million gone. You cannot afford to have this kind of money into this kind of investment. But there is also another investment, could be also volatile, could fluctuate up and down, okay, during the volatile market, but eventually somehow, like you can see in this chart, even though it has like a volatility up and down, but eventually it go to the high point. So this is what I mean, that the investment that can help you to achieve the investment return that you need to attain financial freedom. So you may wonder, what is this chart about? This chart is actually a chart of the index that we call it MSCI All Country World Index. So it's a stock index that tracks nearly 3,000 companies from 23 developed countries like US, Japan, Europe, and 25 emerging markets. like Turkey, like China, like Malaysia. Okay, so you can see from here that if you study this index, you have observed that the value of the stock steadily increased even though there's some volatility and hit the value of 1,480% of return since 1988. If you track it until June 2022, we will see that this investment will have accumulated an annualized return of 8.32%, which is not too bad a return, considering it is a diversified investment. But very important, there is a point of caution when you look at this type of investment, okay, because it's important for you to have the wrong perception and to put all the egg into one basket. Because why? Or you may think that, oh, this talk about stock, this talk about it will grow in the long term. Sorry, what I mean is that when you invest in one stock share in one particular country, it is uncertain that the company or the particular share will continue to do well and rise along. The truth is that particular share may not even survive. Okay, and contrast that to buying a globally diversified portfolio, like I mentioned, you know, what 23, 30 over countries, okay, of shares, invest into different sectors and countries, your investment will always grow in the long term. Why? Because each share in the diversified portfolio may perform differently as economy grow or shrink, and each offer different potential for gain and losses. So as such, even some of the stock may be losing money or discount the overall performance, but you also have enough winning share to cover the loss, you know, and grow your overall. So that's the whole idea of why we should look for an investment that will always rise in the long term, so that will make our job to accumulate our wealth much easier. And this is an example of how one can build a diversified portfolio which has got different asset classes into different portfolio and combined together, you will replicate the MSCI all countries that I mentioned just now. And the third keyword here is B. B stands for best of breed. So it is not just enough just to invest in investment that are safe and will rise long term, because the investment that you select should be best of breed. Investment that will perform the best in its own class and the category. For every asset class or investment category that we intend to invest, we must do enough research to cherry pick, to identify the best investment in the category. We must try, because when you look in the category, then basically it means that you are exposing yourself to the same level of risk. Then between those who are less performing and those that perform better, because it only makes sense that we want to choose those investments that perform better. So for example, if we are looking at how do we invest into Malaysian Equity Growth Fund, then you will see that there are quite a number of different funds here performing differently. And as you can see from the chart, B is doing quite well, giving about 57% return over 5 years. But you can find A fund is performing double the return, okay, among its peers. So this is what I mean by getting the optimal return among the peer with the same risk distribution. So by picking the best of breed product in each category that you invest into, different asset classes, okay, then you will be able to further enhance the return to help you to achieve your, or to accumulate and to grow your retirement asset in a more effective way. Okay, so when you invest into those investments that fulfill this criteria, then it helps you to confidently to know that you can avoid all this risky investment and even scam. You can expect your money to be invested into quality and sustainable investment, so that when you retire, your money will still be there. Even 10 years into retirement, 20 years into retirement, the money will still be there. But if you invest into those investments that do not fulfill this criteria that I mentioned, then I'm sorry, because you are exposing your money to unnecessary risk and may deplete your investment capital. And when you need it the most, and when you are old and you don't have income anymore, how are you going to find the time and money to cover whatever loss? So, and I want to highlight to you again, more than 90% of the investment out there in the market do not fulfill the criteria of the gold standard of SRB. Okay, so some of you may think, wow, Mr. the criteria that you set is definitely so strict, so conservative. If you are thinking like that, then you are right. You know, because when it comes to investing the money for serious financial goals for retirement, lifestyle fundings, there's no such thing as being too cautious. No? This world, unfortunately, is flooded and overwhelmed with many risky investments that the provider is all eyeing for your money. Okay? So I can understand you say, oh, that you may miss some of the good investment opportunity if I use this criteria that Jiaming said. However, I think that it's better to lose some good investment opportunity than getting yourself into the wrong investment that eventually